everything needs to be looked at holistically. You can't look at one piece of data, right? Because I mean, I'd be happy to buy in a market where rents are going down, so long as I get to buy the property at a low enough price to justify the lower rents and perhaps the lower anticipated growth over the next couple of years. And that's frankly what the market is not doing right now. The market is not really allowing assets to trade down in price to a point where you are able to confidently buy in a weaker environment, knowing that things are going to reflect that and then get better later. People are already, we talked about this maybe before, but people are already looking out into the future and they're kind of discounting where fundamentals are today. They know that there's going to be a big supply shortage and they know that there's going to be a lot of rent growth, particularly in growth cities like the major markets of Texas. So the problem is it seems to me like the train is leaving the station. So I don't really look at this near term data as really much of anything as far as like, oh, prices are going to go up, prices are going to go down, or it's a good time to buy. It's just too difficult to say. And you say this all the time. We don't time the market. We just buy fundamentally sound deals. If a deal makes sense to buy and own today, then it probably will make sense to own 5 years from now, 10 years from now, if that's what ends up happening. Obviously, we tend to sell faster than that. But yeah, that's one big part of the equation. And then I know the other part of the equation that you want to cover are rates themselves, because all this economic data affects how rates trade, whether you're talking about treasuries, and then the Fed obviously controls SOFR. And so, and Brad sent us that Cushman article today talking about how heading into 2025, we've kind of flipped into the stage of the cycle where it makes more sense to float rather than fix.